October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday the market went down 508 points, and my fund went from I think 12 billion to 8 billion, and that gets your attention, in two working days. I said at the end of this week I'd be have no fun.
We're halfway into 2022, and despite the slow and steady recovery from the pandemic, the financial market seems to be running into troubles yet again. Trust us, you're not the only one feeling uncertain as you watch the S&P slide downward. With the current state of the stock market, it can be a little unnerving to consider the possibility of a hard correction coming our way. If you are wondering about the best way to protect your stocks, and possibly even profit from an upcoming market correction, this video is just for you. In fact, we've got some absolutely gold comments from investing legend Peter Lynch to guide you through these perilous times. In this video, we're going to expand on some of Peter Lynch's most valuable pieces of advice when it comes to handling market corrections. You'll finish with a good grip on what causes market corrections, and even better, how to turn it into an opportunity for profit. You'll want to stick around until the end, because we include a gem of wisdom from Peter about the best way to time these market corrections for maximum gains. The answer is a little unexpected. Let's get started. Peter Lynch is a widely respected name in the game of finance. In 13 years as the manager of Fidelity's Magellan Fund, he grew the assets from $18 million to a whopping $14 billion. This was fueled by his keen understanding of the market's nature. This is clearly evident by the 29.2% annual return he averaged during his time. So how did Peter Lynch manage to stay on top during his whole career? How did his fund survive major downturns such as Black Monday? Before we get into the nitty-gritty, it's important to know exactly why these recessions happen and when the next one will come. Peter put it perfectly.
And history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks.
If the market corrects itself so regularly, what's actually causing it? I'm going to give you the answer, but it's not as straightforward or clear as you might hope. Because the market reflects investor sentiment, the rise and fall of stock prices in general is due to the supply and demand, or lack thereof, from investors. This is the basic answer, but the forces moving the supply and demand can vary greatly. Here are 3 common causes of market corrections and crashes. Number 1, a shrinking economy. If the economy itself is trending downward, investors do not feel as motivated to purchase shares. When consumers are buying less, companies do worse. Investors become less and less optimistic that its stock is going to go up, so they hold onto their money. As a result, the market begins to decline. Number 2, world events. This is an easy one. There are plenty of examples to choose from. The devastating terror attacks on 9/11 spread fear of war and more, causing a downturn. The COVID-19 lockdowns slowed the economy, but it took investors more than 2 years to become less cautious and re-enter the market. Russia's recent invasion of Ukraine made everyone wary of war or economic collapse, which slowed the market as we're seeing at the moment. Number 3, fear. While fear is certainly a factor in world events, almost anything can spook the market. Fear is a self-fulfilling prophecy. So when investors become afraid of a market correction, that fear itself fuels a downturn. When investors become fearful enough to drive down prices, the rest of the crowd follows and a recession begins rearing its ugly head. Those three causes are very prevalent. Regardless of your time in the market as an investor, you've seen one or all of these come into play. Corrections and recessions can be triggered by a variety of events, but the important thing is that you know how to handle them. Let's look at the moves you should be ready to make during a correction.
You shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Just like Peter Lynch says, these corrections don't have to be a bad thing for you as an investor. In a sense, all these stocks are going on sale. If you have a particular company that you believe is a great purchase, you should be overjoyed to see it be dragged down by the rest of the market. Buying a great stock during a downturn in the market gives you an edge on everyone who will buy it back when things are in the green. In comparison to them, you will make all their gains and more. You might wonder why people don't capitalize on every correction we see. The simple answer is that people are afraid. When a stock is sliding and you wake up to a lower number every day, not many people's first reaction is to look for an entry point. The majority of retail investors stay far, far away. The people who come out on top of these are the ones you hear about today. Warren Buffett, Ray Dalio, Peter Lynch, and every big name you know of spent every recession researching like mad for the best companies to pick up. Either that or they built bigger positions on the ones they already owned. The fact of the matter is that you need to have the mental fortitude to stick to your game plan and hold on to those precious stocks. It's only going up, but not everyone will catch the train.
There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about.
At the end of the day, what really matters is whether you hold stock in quality companies. During good economic times, most stocks trend upwards, but the best companies pull ahead. During bad economic times, most stocks trend downwards, but the best companies regain their positions much quicker. Before we talk about timing these corrections, let's recap quickly. Market corrections and recessions are without a doubt a natural part of the market. Investor sentiments and world events make waves throughout the financial world every year, and there's no telling which ones will be worse. How do we handle them? By holding our ground. Buying stock in strong companies that can get back up after being knocked down is the key to coming out on top as an investor. Once you are holding those golden stocks, you have to keep yourself from falling for fear. Keep your wits about you and buy more smart stocks as the opportunity presents itself. Alright guys, so now we know what a market correction is and how to deal with them when they make an appearance. As any intelligent investor would, you're probably wondering what the best way is to time these market corrections and make even bigger stacks. Well, we have some bad news for you. Rather, Peter Lynch does.
The 13 years I ran Magellan, the market went down 9 times, 10% or more. I had a perfect record. I went down more than the market. Every time I went down more. So I just didn't worry about it. The point is, when you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So my longer term stock market's been the best place to be. Last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks.
As tough as it sounds, there just isn't a dependable way to guess when these next corrections are coming. Just like Peter mentioned, he didn't bring his funds from millions to billions by seeing into the future or using advanced mathematical algorithms to time the next correction. He grew wealth by not worrying about when the next correction would come. If you're worried about bad timing in the market, let me remind you of one particularly famous quote by Ken Fisher. Time in the market beats timing the market. There's no such thing as timing the market, much less timing the corrections and recessions. If you can't handle that, it's usually because you might need the money and can't afford to wait while it is shrinking in a downturn. That's nothing to feel bad about, but it's something to be considered as you look at stocks to buy. These strategies are used by the most successful investors because they are dependable and return huge gains. That being said, it also requires the investment of time. If you are investing your savings you plan to keep in the market for years to come, then you'll hit every correction with perfect timing. If you have any suggestion as to what topic you want us to cover, post your comments. Now, if you want to learn from the best, we made a video on Warren Buffett's mentor, Benjamin Graham, and how he beat the market every year. There's a lot to learn from this guy. See you next time.